There has never been a better time to invest in Avalanche if you are holding for the long term. In this AVAX analysis, we will share with you our buy zone. But first, using AVAX Fibonacci, we will carry out a forensic examination to see the signs telling us that AVAX would fall. Why is this useful? Because if you reverse the logic, it will also tell us when AVAX will rise. Our focus of attention is the last 5 months, and we see price action moving sideways. This was confirmed by our volume data, ranges between February to May which were compressing. Sooner or later, we knew it had to pop, and that was this month. What many traders miss is measuring the ranges to determine resistance and support zones. We measured the first leg up from the structural low to the first high and projected it from the next lower high. That gave us a price level of 10.320. We then measured the next range up from the March low to the April high and projected it from the next higher low. That gave us 10.540. That gave us a zone between 10.320 and 10.540. The significance of this only became apparent much later. If you enjoy this style of Fibonacci and swing trading analysis, subscribe to our channel, and we also produce a newsletter, link in description. The 17th March high came in at 10.534 and the 10th May high at 10.485, both within our zone. But not only that, as we pointed out in our previous AVAX analysis, we were at this year's 2026 midpoint, shown by the dotted line. This is itself tough for buyers to break through, but what looked like a sideways market was actually building up resistance. Each rally was running into virtually the same ceiling. Using our Fibonacci analysis, we already calculated a strong Fibonacci resistance zone between 10.003 to 10.127. And when we applied the 2026 anchored VWAP, we knew buyers were faced with formidable resistance to break through. By this stage, Avalanche wasn't facing one resistance level, it was facing multiple layers of resistance stacked on top of each other. But now let's focus on this June fall. The March and May tops had effectively produced a double top, but to be a valid double top, the lower high must break the last swing lows, and this was confirmed when it broke the third May low. But also, when we layer the Ishimoku chart, we had a TK cross occur signaling a sell. The evidence was beginning to stack up. It was the daily swing chart which gave us the clearest signal. When we see expanding swing ranges from lower high to lower low, it tells us momentum was building. So by the time it went below the 29th March low, the snowball effect of momentum accelerated the decline. Now, one of the key features of double tops traders often overlook is that the minimum price target is 200% of the range. The calculated range of 1.726 from the 17th March high at 10.534 to the 29th March low takes us to a 200% target of 7.082. The current price is 6.6764. So, has AVAX reached its bottom? We don't think so. We have done the Fibonacci calculations and we anticipate the buy zone to be between 5.718 and 5.820. This healthy pullback into our Fibonacci zone will push Avalanche into oversold territory and potentially provide long-term investors with an extremely attractive accumulation area. And remember one thing that is often forgotten. When price falls rapidly without building support on the way down, as we have seen during this June decline, it often leaves a gap in the market structure. There are very few areas where buyers and sellers previously agreed on value. What makes this important is that the same lack of structure that accelerates a decline can also accelerate a recovery. If Avalanche begins to reverse from our buy zone, there is relatively little overhead resistance until much higher prices. In other words, the market can recover lost ground surprisingly quickly because there are fewer structural obstacles standing in its way. This is why healthy pullbacks can be so powerful. They reset sentiment, shake out weak holders, and create stronger market structure from which larger and more expansive moves can eventually develop. But we also want to put this decline into perspective. This isn't simply because Michael Saylor sold 32 Bitcoin. The bigger picture is that capital is constantly searching for the next opportunity. Over the last 12 months, the AI boom has attracted trillions of dollars of investment and speculation. When investors need to free up capital, Bitcoin and cryptocurrencies are often among the most liquid assets available to sell. And to put this into perspective, this market is $19 trillion, 13 times the size of the current crypto market. This is why major crypto declines are often about far more than crypto itself. And with some of the most anticipated technology companies coming to market over the coming years, competition for speculative capital remains intense. The important point is not where the money is going. The important point is understanding that periods of extreme weakness often create the opportunities that long-term investors spend years waiting for. We only need to look at Avalanche's historical highs to understand the type of upside that can eventually follow from buying quality assets during periods of extreme pessimism. Remember, we're not talking about day trading. We're talking about positioning as a buy and hold investor to potentially capture outsized gains over the coming years. If you found this analysis useful, subscribe to Crypto Trading Mastery and hit the notification bell so you don't miss our next daily video. Thanks for watching.